Welcome to the Deep Dive. We're here to take those really dense financial reports, the ones packed with data, and turn them into something clear, something you can actually grasp.
Exactly. The idea is you've got this complex analysis, maybe you need to understand the key story fast. Well, that's what we do.
We cut through the jargon, pull out the important bits, find those surprising facts that really matter.
Get you beneath the surface, basically.
And today, we're diving into Sambhv Steel Tubes Limited. They're a company at a really interesting point right now, a big strategic shift happening in the Indian steel scene.
Yeah, a major transformation. Our main source here is a detailed fundamental analysis report. We're going to be pulling out the key takeaways on their business, their number, where they might be headed.
Our mission really is to give you a solid but digestible picture of their journey, their strengths, and their challenges too. Okay, let's get into it. So, first off, Sambhv Steel Tubes. What kind of company are we actually talking about here? What's their core business?
Right. So Sambhv Steel Tubes Limited is essentially an integrated manufacturer. They specialize in what are called electric resistance welded steel pipes, ERW pipes, and structural tubes.
Okay, ERW pipes, those hollow sections you see everywhere.
Pretty much. They're vital components in loads of industries, and that integrated part is really key to how they operate.
Integrated. What does that actually mean for them on the ground? How does it shape their business?
It's fundamental. They have significant backward integration. So they're not just assembling, they're making intermediate stuff like sponge iron and hot-rolled coils, HR coils themselves.
Ah, so they control more of the process.
Exactly. And they've even pushed into stainless steel products recently. The whole idea is efficiency, better cost control, and crucially quality control right from the beginning of the process.
Makes sense. Control the inputs, control the output quality. What about their main finished products? Where do these pipes and tubes end up?
So the main things coming out the other end are those ERW black pipes and tubes and also galvanized iron GI pipes.
And the applications?
Oh, they're incredibly diverse. You'll find their stuff in housing, big construction projects, infrastructure, agriculture, cars, telecoms, even oil and gas pipelines. They're kind of woven into India's growth.
Okay, now this is where the report threw up something interesting, maybe even a bit confusing at first glance. It mentions negative revenue growth, almost 21% down, and volume growth down nearly 11% in the first 9 months of fiscal 25. That sounds bad.
Yeah, it does look like a red flag initially, doesn't it? But it's not a simple market slump for them. It's actually a direct result of a strategic choice they made.
A strategic choice causing negative revenue growth. How does that work?
They decided to massively increase captive consumption. Remember those intermediate products like HR coils?
Yeah, the ones they make in-house.
Right. Instead of selling as much of that externally, they're using way more of it internally to make their finished products. So HR coil sales, which were like over 60% of revenue back in FY22, plummeted to less than 0.5% in this recent period.
Wow, okay. So they're essentially shifting sales from a lower value product.
Yeah, precisely. To feed the production of higher value finished goods. And you see the flip side. ERW pipes and tubes, which were basically zero in reported sales value in FY22, suddenly jumped to almost 75% of their revenue.
Ah, okay. So it's not that the business shrank overall, it's that the type of revenue changed dramatically. They're aiming higher up the value chain.
Exactly that. Capturing more value themselves rather than selling the intermediate stuff. It's a major strategic pivot.
What are the sort of pros and cons of doing that? I mean, better margins eventually, I assume.
That's the goal, yes. Higher potential margins on the finished goods. The downside, or challenge, as you saw, is it makes the top-line revenue look weird for a bit. You have to explain it. But long-term, it should position them better.
Right. Okay, so that's the what. Let's talk about the how. What gives Sambhv Steel its competitive edge? What makes them stand out?
Well, a big one is location, location, location. Their plants are in Raipur, Chhattisgarh.
Which is good.
It's resource-rich, puts them right near key suppliers for iron ore, coal, including some big government-owned players, the Navratnas and Maharatnas. That cuts down logistics costs, transport time and money. And Chhattisgarh works well as a distribution hub, too.
Makes sense. Smart location. What about inside the factory? Any special tech or processors?
Oh, definitely. They've got some key process innovations. One major differentiator is making narrow-width HR coils in-house.
Narrow-width HR coils. Why is that special?
Because hardly anyone else in India does it. The report said only one other player as of late 2024. Doing it themselves cuts down on capital spending they'd otherwise need and makes them less reliant on outside suppliers for this really crucial component.
Okay, that sounds like a genuine advantage, a barrier to entry for others. Anything else on the tech front?
Yeah, they use some advanced steelmaking stuff like argon oxygen decarburization AOD that's good for making higher quality stainless steel cost effectively, and a ladle refining furnace, or LRF, for special alloys. Think Corten steel, the kind that resists corrosion really well.
Corten steel, right? And what about costs? Energy is always a big one in steel.
Good point. They tackle that with captive power plants. They use waste heat and gases from their processes, even low-grade fuel to generate their own electricity. That definitely helps keep production costs down.
So let's tie that all together. The location, the special coil tech, the advanced steelmaking, the captive power. What's the big picture impact on their competitiveness?
It means they've got much better control over the quality of what goes in. They're less dependent on others. And critically, it lets them make these niche, higher margin products like the special stainless or the Corten steel. That lifts them out of just competing on basic pipe prices, creates a higher barrier for competitors wanting to do the same.
And once they've made all these great products, how do they get them out to customers? How wide is their reach?
It's pretty extensive.
Yeah.
As of late 2024, they had something like 37 distributors working through 43 different points across 15 states and a union territory, plus over 700 dealers.
Wow, that's a solid network.
Yeah, and they also sell directly to big construction and infrastructure firms and even government bodies, so they have multiple channels to market.
Okay, let's switch gears to the financials. Given all this strategy and innovation, how do the numbers actually stack up? Revenue first. How's the top line looked over the last few years?
Well, setting aside that recent 9-month strategic dip we discussed, the overall trend has been strong growth. Revenue from operations went from just over $8 billion in FY22 up to nearly $13 billion in FY 2024.
That's a big jump. Almost $13 billion, a 37% increase just in FY24.
Yeah, pretty robust top-line expansion.
But, and this is where it gets interesting again, right? The profitability puzzle. Gross margins improving, but operating and net margins, not so much.
Exactly. That's the real crunch point right now. Gross margin, what's left after the direct costs of making the steel that's actually improved steadily, went from around 24% up to over 30%.
Which sounds good. More efficient production.
It suggests that, yeah. But then you look further down the income statement. EBITDA margin, earnings before interest, tax, depreciation, amortization, that fell quite a bit, from over 15% down to about 10.5%.
Yeah.
And the bottom line, profit after tax margin, or PAT margin, saw a similar drop, from nearly 9% down to 4% over that same FY22 to 9M FY25 period. Even the profit per ton they make took a hit.
So what's going on? Why the disconnect? If they're making the actual pipes more efficiently, what's eating the profit?
It boils down to overheads. Significant increases across the board. The report flags things like employee costs more than doubled. Finance costs, paying for debt, up significantly too. Depreciation, that's the cost of all the new factories and machines, more than doubled as well because of all the aggressive capital spending.
The cost of expansion.
Exactly. And then there's a bucket called other expenses, which just ballooned, nearly tripled. So while they might be getting better at the core manufacturing, these other operational costs, linked to scaling up and investing heavily, are really squeezing the operating and net profitability right now.
Okay, that paints a clearer picture. What about cash flow? Is the business actually generating cash from its day-to-day operations?
Well, that's another area showing strain. Net cash from operating activities actually flipped negative in the first 9 months of FY25. They used over 420 million rupees, whereas it had been positive before.
Negative operating cash flow. Why?
Mostly down to working capital changes. Inventories shot up, meaning they've got a lot more unsold stock tying up cash. And trade receivables also increased substantially, meaning they're waiting longer to get paid by customers.
Okay, so cash is getting tied up in stock and unpaid bills. And free cash flow. The cash left after they pay for all those new investments.
That's been consistently negative, and it hit a pretty large negative number in 9M FY25 using over 2.3 billion rupees.
Wow.
Yeah, it really highlights how capital-intensive this business is, especially during this expansion phase. They are heavily reliant on external funding, debt, or equity to keep the wheels turning and pay for the growth.
And you see the impact of that heavy investment on efficiency metrics too, right? Like return on equity.
Absolutely. Those KPIs took a sharp dive. Return on equity, ROE, went from a, frankly, very high 63% down to just under 9%.
Huge drop.
And return on capital employed, ROCE, similarly fell from nearly 29% to under 8%. Fixed asset turnover also declined. It tells you that while they're pouring money into assets for growth, those assets aren't yet generating the proportional returns. The capacity isn't fully ramped up or utilized efficiently enough yet to justify the capital spent, at least in the short term.
So they're clearly betting big on the future with all this spending. Can you detail these expansion plans a bit more, and how are they funding it all, given the cash situation?
They are definitely going big on expansion. Their existing Sorora facility is getting a capacity boost, going from about 1.1 million tons per annum up to over 1.5 million.
Okay.
Then there's the new Cuthrell facility that just came online in FY25, adding another 158,000 tons. And crucially, it's focused on those value-added products like galvanized coils and pipes and stainless steel.
And I remember reading about a completely new site, a greenfield project.
That's the big one for the future, the proposed Kesda facility. It's planned to add around 1.2 million tons per annum eventually, built in 3 phases. Phase 1 is targeted for FY 2027. They've got the land, they're buying the equipment. It creates this sort of manufacturing hub for them in Chhattisgarh.
Right. And alongside adding capacity, they're diversifying products and markets too.
Yes, definitely. New stuff like pre-galvanized pipes, which are good for coastal areas where corrosion is a bigger issue, cold rolled full hard pipes, and a much wider range of stainless steel products. Geographically, they want to push into states where they're less present, like down south in Kerala, Tamil Nadu, and even look at expanding internationally eventually.
Is a multi-pronged growth strategy.
Yeah.
Build more, make different things, sell in new places.
Pretty much sums it up.
Now, are these plans happening in a vacuum, or is the broader market supportive? What does the industry outlook look like, say, according to Crystal?
The Crystal report cited seems quite positive, actually. It projects really solid demand growth for steel pipes and tubes in India, maybe 8-9% compound annual growth rate, CAGR, through to FY 2029.
8 to 9% growth per year? That's strong. What's driving that?
A lot of it is government initiatives. Big spending on urban infrastructure, oil and gas projects, irrigation schemes. These all use a lot of steel pipes.
And wasn't there something about steel replacing other materials?
Yeah, material substitution is another trend. Lighter tubular steel is being used instead of older, heavier conventional materials. The example given was railway station upgrades under the Amrit Bharat scheme. Apparently, each station could use hundreds, maybe thousands of tons of steel tubes for things like footbridges.
Interesting. And stainless steel specifically.
Also looking good. Crystal forecasts 7-9% cent GGR for stainless steel demand. And ongoing government water schemes like Jal Jeevan Mission, aiming for tap water in every home, are huge potential demand drivers too. Billions of dollars expected in investment there.
Okay, so the industry backdrop looks favorable. Which brings us neatly to the IPO. You mentioned their reliance on external funding. How critical is this upcoming IPO for Sambhv?
It seems absolutely pivotal. Crucial, really. They've earmarked a very large chunk of the planned proceeds, nearly 4 billion rupees, specifically to pay down debt.
Deleveraging.
Exactly. Reducing that debt burden will cut their finance costs, which, as we saw, were really eating into profits. And, of course, it provides vital capital to support all this ongoing expansion and gives them more financial breathing room, especially given those tight liquidity and cash flow numbers we talked about.
So it's less about just grabbing cash for growth and more about fixing the balance sheet to enable sustainable growth.
That seems to be the core objective, yes. Strengthening the financial foundation.
Okay. But like any investment, there are risks involved. What should people be aware of? Let's start with the industry itself.
Well, the steel industry is notoriously cyclical. It goes through booms and busts. It's sensitive to raw material prices, which can swing wildly. Global demand shifts, how much capacity everyone else is building. Even geopolitics, think oil prices, trade wars, tariffs, all that can hit revenues and margins hard. It's just the nature of the beast.
Right, inherent volatility.
Yeah.
What about risks specific to Sambhv Steel, based on the report?
There are quite a few flagged. Operationally, there's always the risk that even after building all this new capacity, they might struggle to utilize it fully if demand doesn't materialize exactly as hoped.
Underutilization, yeah.
They also rely on third parties for key raw materials, and the report notes they don't have long-term contracts. That could affect their bargaining power or even lead to supply disruptions if markets get tight. And there's some concentration risk relying too much on a small number of suppliers or customers.
Okay, those are operational risks. What about financial ones?
Well, their loan agreements have restrictive covenants, basically rules they have to follow. The report mentions past instances where they weren't fully compliant, though apparently without penalties. But it's something to monitor. Default triggers are possible.
Right.
We already talked about The big working capital needs the cash tied up in inventory and receivables. Collecting those receivables efficiently is crucial. And they're exposed to floating interest rates on their debt, so if rates go up, their finance costs could climb even higher.
Any red flags on the governance or compliance side?
The report did mention some past history of delays in making statutory payments like employee benefits contributions. Also, some past observations from auditors about things like accounting for post-employment benefits and the audit trail capabilities of their accounting software. They seem to be addressing these, but it points to areas where internal controls perhaps needed strengthening.
And their credit rating.
It was stable as of the report. Date care, a stable, a stable, which is decent, but any future downgrade would make borrowing more expensive and potentially harder to access.
Okay, so quite a few things to keep an eye on there. Let's try and pull it all together now. We have the growth story, the strategy, the financials, the risks. What's the final verdict on the valuation being asked for in the IPO and the overall outlook?
Right. The offer price is set at 82 per share. Based on their earnings for fiscal year 2024, that works out to a price to earnings or PE ratio of 21.64 times.
21.64. How does that stack up? Is that high, low, average?
Well, compared to their own recent history, looking at the average earnings per share from FY22 to FY24, it's significantly higher. That weighted average EPS was only 3.50. So the 21.64 PE based on FY24's 3.79 EPS definitely implies the market is pricing in future growth.
Okay, betting on the future. How does it look next to competitors, their peers?
It's kind of in the middle, maybe slightly higher end. It's way below a company like APL Apollo, which trades at a much higher PE, but it's very close to Harry & Pike's PE, and it's certainly higher than some other players in the steel pipe sector. So not cheap, but perhaps not outrageously expensive compared to some peers.
So what's the justification then? What are the core strengths highlighted in the report that might convince an investor this price is fair?
Qualitatively, you'd point to that backward integration, the strategic location, the process innovations like the narrow width coils, that's a big one, the wide distribution network. Experience management is usually cited too.
And quantitatively, what numbers back it up?
Improving gross margins are a positive. A high return on net worth, even though ROE dipped recently, was still over 25% in FY24. Their EBITDA margins, while declining, were still higher than the peer average in FY24. And of course, the sheer scale of capacity growth is impressive, from under 400,000 tons in FY22 to nearly 1.7 million tons planned by FY25, plus those positive industry growth forecasts we mentioned.
Right, but we have to balance that against the recent financial strains, don't we? The falling operating and net profits, the negative cash flow.
Absolutely. That's the crucial risk-adjusted view. Yes, the potential is there, backed by real assets and strategy, but the valuation has to be seen in light of those pressures. The profitability squeeze, the negative operating cash flow, the fairly high debt-to-EBITDA ratio close to 6, that current ratio under 1 indicating liquidity pressure.
So the payoff depends heavily on execution.
Totally. Successfully ramping up and utilizing all that new capacity efficiently is key. And perhaps even more importantly in the short term, using those IPO funds effectively, especially paying down that debt, is absolutely paramount. They need to do that to justify the current valuation and start improving those capital return metrics again.
So wrapping up, what we've seen is a company in the midst of a really ambitious, major strategic overhaul. They're making big bets, investing heavily to climb the value ladder and ride these strong waves in the Indian steel market.
Yeah, big bets. But that ambition, while it holds long-term promise, has definitely created some serious short-term financial headwinds. You see it clearly in those squeeze margins and the negative cash flow figures.
Which makes the upcoming IPO and that planned debt repayment feel like a make-or-break moment, doesn't it? It's critical to ease the pressure and really set them up for sustainable growth. Success really hinges on making those new plants sweat and turning those financial numbers around.
Definitely. And watching Sambhv navigate this phase, it really brings up a broader question for industries like steel capital intensive, cyclical. What does strategic transformation actually cost? And how long can a company sustain this kind of heavy investment and short-term pain before the market demands to see the results, the returns?
It's a fascinating balancing act. What stands out to you as the single biggest factor that will determine their success or failure going forward?